Zach, thanks so much for being with us today on the CRE project. Stoked to have both you guys. So thanks for taking the time. Greatly appreciate it.
Yeah.
Thanks, Clyde.
So
Appreciate it.
let's dive right in. We've given the listeners kind of, a background on who you guys are. Obviously, real heavy hitters in the single tenant net lease space, both well-established brokers with Marcus and Millichap. Let's dive in here. I mean, we're right in the heart of COVID right now, and everyone in the real estate field seems to just be going in different ways, and there's not really a whole lot of predictability. And you guys specializing in an asset class that offers a level of predictability to a lot of different investors. We kind of wanted to just get you on the show and just kind of get a state of the asset, if you will, and just kind of fill our audience in. I mean, what's going on out there right now in the single tenant net lease space? What are you guys seeing?
I'll take a stab at that first. Right now, we've been fortunate. We still have a marketplace that's transacting. Starting back in March when this all happened, we probably lost about 20-25% of our escrows. Since then, that cancellation rate due to coronavirus has slowly dwindled. We still have plenty of issues that we're dealing with due to coronavirus, but for the most part, I would say we're not drastically far off where we would have been otherwise. But mainly all the interest has been and this sounds cliche at this point, but essential use, properties with term, and properties in core markets. The deals in tertiary markets or deals that don't have the right credit or that haven't been essential use, obviously like gyms, daycares, sit-down restaurants, those have been very tough to move. But fortunately, there's been enough product out there that is outside of that categories as brokers that we're able to try to work and put deals together. So and the other thing is just the 1031 activity was so, there was so many 1031s going on out there in the marketplace through the first quarter and even the beginning of the second quarter that we've benefited from those exchanges that had to occur. There's this July 15th cutoff date that everyone's talked about in the marketplace where exchanges the IRS extended exchanges to July 15th. And so after that date, the theory is, all activity will drop off. We do not believe that's going to be the case. I mean, we think it's going to be we're going to see potentially a drop off, but there's still a lot of money on the sidelines that's starting to come back to deals. Starting to see non-1031 buyers want to buy property right now. So that's kind of exciting, even though we still have plenty of challenges that we're going to face.
Yeah. I'm curious, how has the buyers, how has their behavior changed over this whole thing? I mean, are people more timid? Are they being more invasive on their due diligence? I mean, are they studying property more? Are they changing the type of assets that they're going after? I mean, what are you kind of seeing as it relates to, buyer behavior?
I can take that. Yeah, I mean, in terms of buyer behavior, it's really they've just gotten a lot pickier. It's the quality of the asset has gotten significantly more important than we've seen in the past. Like if we're looking at 6 to 12 months back, we're selling franchise credit at virtually the same cap rates as we would be selling corporate credit. You got these 10 to 50 unit franchisees for Burger King and Arby's and all these other products that we'd previously been selling extremely aggressively. I think over the past several months, we've seen buyers get a lot more picky, looking specifically for corporate credit and kind of like Mark talked about, it's got to be more essential use. They're not really touching gyms. They're not touching sit-down restaurants right now for the most part. So it's really just about the quality assets, and we've seen the majority of demand move to that sector, just buyers looking for security.
Have you guys seen any flexibility yet? And if not, when do you predict some flexibility on the seller side in the event that you do own a non-essential type of asset like a gym?
Surprisingly, we really haven't seen a lot of flexibility yet on pricing. Now, that's just a general statement.
Yeah.
The pricing is held very well with all the things we're talking about, you know, the credit, the essential use. So pricing's held very well, very well. No real change. With respect to these gyms, daycare, some casual sit-down restaurants, those categories, the non-essential use, even some of these like big box dry goods stores that really don't serve a purpose that's needed. There just hasn't really been many transacting. And so it's just like literally been shut off. So when things get picked back up, you know, the question will be, well, what happened to the pricing on those? Like, is it off 50 basis points? Is it off 100? It's to be determined, but certainly one would think there's going to have to be some trade-off on those assets for anyone to really actually want to take the risk to buy one.
I mean, no crystal ball, but what do you predict?
I think that, okay, my crystal ball, you know, is that the core market deals, the major MSAs, the credit, the deals with lease term, all the same old things. I don't think there's going to be much movement on those. I just don't see it happening with rates the way they are and the security that those investments offer. I just don't see it. I mean, some of our clients think that cap rates on that product will compress. I don't know that we're in that boat, but we're probably just in the neutral boat, the as is boat. As far as when things come back for those non-essential uses, it might take till fourth quarter when there's maybe, you know, the election's out of the way. There's a antibody or a
vaccine
that would cause those to be more desirable.
So I'm just curious. So you said, and you believe that there will not be compression in cap rates on essential product.
As far as compression, I don't know that I necessarily see it. But they're already at very compressed levels. Mm-hmm. I mean, we're at January pricing. Pricing now for those deals is like it was in January. So I feel like in January we are already pretty much at a very, very heavy compressed cap rate environment.
Yeah.
What about new construction, guys? Have you seen new starts continue, or is there a delay? And if you think there's going to be some type of bottleneck and new opportunities, it seems like that may lead to some cap rate compression if there's less inventory out there for investors to choose over. Are bankers still lending? Have you seen construction still continue, or is that stalled out at all in your market?
Yeah, I mean, I would say it's 50-50. You know, there's certain retailers obviously that are pressing the pause button on a couple things. Some of them are pressing the pause button on even looking at sites in general right now. Others are just going down the road and not signing new leases. That's where a majority of them have been at over the past few months. You know, they'll talk with their developers. They'll basically get everything teed up, but they're not signing on the dotted line. And then you have the third segment of that, which is actually starting to move dirt and you know, pushing back opening timeframes. And, you know, I was talking with the client I'm working with that's got a First Watch restaurant, and that's a Southeast concept that does, you know, they're a diner. And they've pushed back their opening date by 6 months to try to give them, you know, a better head start. You know, nobody that's a sit-down restaurant wants to be opening right now or even any time over the next few months. So I still don't know that I necessarily see that causing a cap rate compression. It's just because cap rates are already so low. I mean, it could, we could be wrong about that, but you know, it certainly could affect the amount of new construction inventory that's hitting the market in the next 6 months to 12 months.
Yeah. Yeah.
Yeah, I was curious about that because we kind of lag. And I mean, candid again, locally, it all connects. We're more on the front line of the retail side with tours and everything else. And to your point, I mean, if I just had a conversation this morning, literally, of a deal we're trying to get done, and the only thing honestly holding it up is the flight restriction for the real estate manager to come and actually approve the site. So, and that's been delayed now for 4 months. So I think, again, we're not really going to see the impact of that till, late next year. Have you guys had anyone, I'm curious, have you had anyone pull out of a potential acquisition in order to kind of save some dry powder in the event that there is a correction in the market where there could be potentially more of a value play? Have you guys seen any of that happening at all?
Well, we have had some non-1031 buyers cancel on us over the last 60, 90 days, which, it's hard to blame them if a lot of them have just said exactly that. I just want to keep dry powder for what's to come. And that's been frustrating. But we've also had a lot of calls from the investor pool saying, hey, show me opportunities, and everyone thinking that there's going to be blood in the water, which we just really haven't seen yet. I mean, there's certain situations you could argue have been kind of, dire for the ownership, or the developer needs to get out or whatever. But we just haven't seen a lot change. I mean, I think maybe in the third quarter, you'll start to see, some of these concepts that are going bankrupt and maybe some value add acquisitions be out there. But
yeah, I think we're actually at an interesting spot. I mean, this is June 30th today, and I was talking to a client of mine earlier, and I said, we're at an interesting point because the PPP is starting to run out for a number of folks, and then unemployment is coming up here real quick, along with this 1031. I mean, there's just a lot of dynamics happening in July that will, because I tell people that too. I said, as far as the distress level in the market in general, I just haven't seen it yet. I mean, I haven't seen any type of correction. No one's seeming to be in a distressed position yet. When that happens, everybody we've had on the show, we've had Spencer Levy with CBR. I mean, everyone that I've listened to said Q3, Q4, you're going to start to see that. But I mean, even the people that are at minimal, occupancy or minimal operating, I mean, they still seem like they've positioned their financials to kind of operate like this for the next, 6 to 12 months. So it'll be interesting to see what happens. So
yeah, and I mean, you look at this second wave of now states announcing new closures, like Arizona, like closing gyms and restaurants now, or bars. And then, there could be a second wave of rent abatement requests. What's this whole second wave going to look like is really, I felt like just at the end of like May, beginning of June, everything was starting to reopen and it was started to feel a lot better. But now it's like, wait a second, are we going to have this happen again? It's just uncharted waters. Yeah.
Hey, Mark, can I ask you a question? Are any of your investors concerned or following the proposed legislation in California that would give tenants the ability to renegotiate their lease or terminate should a black swan event like COVID happen again? Do you guys have your finger on the pulse of that at all? I don't know how much it's steam. It looks like it passed the next hurdle and is moving on to the House or the Senate out there. I'm not certain, but it's still in the news. Are you guys following that at all?
I mean, we've heard about that, but not closely. It's not something that's come up a lot in conversation. More than anything, we just track the apartment market in California, just because that's a huge driver for us in the net lease space. So yeah, that'll be interesting. I mean, it reminds me of, what was it, a year ago? I forget what proposition it was, where they, with the whole rent control thing. And there's always something new coming out of California that will affect, because it's a big part of the capital pool. So
And I guess to kind of coattail off of Gannon's question, one thing that we're starting to see, and there's been some fistfights going on negotiating wise on the lease side, is new COVID language trying to be incorporated into these leases. Have you guys had any of your clients? Have you been exposed to that at all? Are you counseling them on that, or is that still pretty foreign to y'all?
No, I mean, we've definitely seen that quite a bit, especially being that we work with a lot of Starbucks developers. They're really the one that's laying down the hammer right now, and just some of the clauses that they're throwing out there in their new leases are, I mean, they make the deals unsellable, really.
Amen. Yeah.
If a developer starts accepting some of the first draft language that some of these guys are throwing out, it's really not going to be good for a lot of us. But, talking with a lot of the Starbucks developers, I think there's a middle ground that can get done. And there's certain language I've seen that I would feel relatively comfortable with, that kind of appeases, the tenant, but also gives the landlord and really the future buyer peace of mind. So I think there's going to be a middle ground, and it's really going to, have to be, it's going to be another negotiating point.
And what does that look like, Zach? I mean, what does the middle ground look like where an asset, because again, on you guys, I mean, you're on the disposition side and on the acquisition side. I mean, where is that middle ground where there is some protection in the event something happens, that the tenant has the right to terminate with a certain amount of, a penalty fee, or what? Coach us a little bit on that. What are you guys seeing?
Yeah, so with the Starbucks example, that's the best example I can think of. I mean, I had one client that was successful in basically getting language approved that said, one, if the government shut down the interior, the drive-through, and curbside pickup for 2 consecutive months, and Starbucks is able to prove that store sales have dropped by 40% compared to the last year's previous average, then they'll reduce rent by 40%. And it's really going to be a deal by deal basis. It's not going to be the same for everyone, but getting rid of that termination clause is the main thing. You can't have that. So there's going to have to be some sort of reduction and what that looks like, and basically painting a picture so that I just don't see Starbucks ever shutting down their drive-through and curbside pickup. So I think that's something as brokers that we can pretty easily sell past and get somebody comfortable with.
Yeah.
So,
and I'm with you.
I've got another question. The single tenant net leased asset class encompasses a lot of different things. And I think to an outside or junior broker or investor looking in, you think of quick serve retail or drive-through restaurants. Are you guys seeing any movement towards, the dock in the box concepts, or financial institutions and banks, or any other particular arena that may be the next darling that seems to be gaining some momentum?
I think following that, I think what you're saying is just like, do you mean like things we've heard among retailers adapting to more of a drive-through only model, shrinking footprints?
Yeah, or even investor preferences. If they're looking for more institutional investment grade opportunities, are they looking for banks that are standalone, freestanding buildings on an out parcel, or are they urgent cares, for example, the dental concepts, some of the recession resistant operators like you had alluded to earlier, or are people still pretty strong with the fast food, quote unquote?
I'll give you an example. Like, we had a single tenant Verizon property under contract. And when this all happened, the buyer was in an exchange, so we had to buy something. And when this all happened, this is back in March, April, he canceled the contract and put his money into a single tenant Black Rock coffee drive-through. It's a drive-through concept, and also a Starbucks drive-through. So he's buying those two deals instead of this larger Verizon property because, you know, his preference is that he wants to be aligned with a retailer that has the drive-through. We always all liked the drive-through. I mean, we all knew how valuable it was, but I think it's that much more valuable. And I think, like we heard the other day, that Denny's is now trying to add drive-throughs to all their locations, which is genius. They should have done that a while ago. I think what you're going to see, and I'm just guessing, I don't know that I've actually heard this. I think I've made it up in my mind, but it probably will happen, is like you look at Burger King, Taco Bell. Why do they need all that dining room space? I mean, they don't really need it.
I think Clayton and I had a conversation offline last week about that. It just, I mean, we're seeing that too.
Yeah, I have a client that literally said, I mean, obviously everything is traumatic that's happening out there right now, but there's always good in everything. And he said that there's actually been a lot of good that's come out of this, and they're a drive-through concept. And he said that our prototype is made to serve a dining room where the majority of our business does not happen, and even more so now with COVID. So they're changing their whole prototype footprint to serve the drive-through window because that's where the majority of their business is. So to your point, it's going to be interesting to see how prototypes, you know, morph and how retailers pivot to cater more towards
or if the dining room even ceases to exist.
Yep.
We'll see. We'll see. I think the other thing is like just in a lot of these restaurant chains, we're kind of already getting this, is just the drive up, the pickup window. But I think pickup windows now not everyone wants to sit in a drive-through lane, but if you're going to order ahead, just you're still going to need parking, and you're still going to need, big kitchen, but just pickup windows. Yeah. I mean, I think that's yeah.
What are some of the key characteristics, and this isn't necessarily to COVID, but just in general, that investors, what are the most important deal characteristics that they're really scrutinizing when underwriting or looking at a single tenant net lease asset? I mean, what's kind of the tiers? Is it the term that's the most important? Is it the rent to revenue that's the most important? Is it the financials of the overall corporate? I know it's probably all the above, but typically what do you guys see in your leases that demand the highest price and for the asset?
Yeah, I think it comes back to security being the most important thing, and the second being ease of ownership. Majority of the people that we're selling to oftentimes aren't involved in this sector before we put them into a deal. Like last year, 60% of our buyers were exchange buyers, and about 35% of that, 53% of that were coming out of apartments into net lease for pretty much the first time. And so that means that there's a couple things that they're going to have a preference on. Is one, the absolute triple net lease structure. They, in many cases, they want as minimal landlord responsibilities as possible. So to read through the landlord and tenant obligations and understand that, once you purchase this thing, you really don't have to do anything is important to a lot of folks. And there's tenants that just won't do it. Obviously, like Starbucks and a lot of the cell phone guys and a lot of the dental users won't do it, but that's important. Term is obviously important. The longer the term, the better. So 15, 20, occasionally 25 years on the lease. The credit of the tenant, of course, is obviously a huge aspect. And then more in recent years, and especially this year, the actual real estate itself has become, I think, maybe the top priority.
That's what I was going to ask, is how often does the actual fundamentals of the property, because oftentimes we'll see these portfolios come out of like Dollar General for example. And I mean, a lot of them are in the middle, quite literally in the middle of nowhere.
Right.
And and you still see those trade for a pretty low cap rate. So I'm curious if that's kind of shifted a little bit to where it's come down to really the fundamentals of the underlying real estate, adding to that security that you've kind of talked about.
And I'll give you an example on that. So I've been working with this trade buyer who sold a small apartment building in California. He had put a Family Dollar under a letter of intent, and it was in a tertiary market in Arizona. I think it was a Family Dollar. And then we also have a human being coffee drive-through that we had listed, but it was a really good piece of property in Phoenix proper. So on one hand, you have the Family Dollar, which is not the best underlying piece of real estate. And then meanwhile, you have a great piece of real estate, but you have, an 800 square foot kiosk drive-through only coffee store. And I think the rent was big. It was big, like $140 a year. And so fundamentally, you're probably not going to replace that rent per se if anything ever happened. And so he was debating the pros and cons, and he ultimately went with the better piece of real estate, even though the fundamentals of the rent were out of check, or not really in check. But once again, the location won, if you will.
Critical.
Yep. Great.
I'm curious how because you guys have mentioned it even a couple times on this call, and this is kind of COVID related to a certain extent, but how big of an influence do core markets play on the overall nation when it comes to single tenant net lease investment? I mean, we see a lot of money in New Mexico coming from California, Phoenix,
The coasts,
Dallas,
both sides.
Exactly, both on the coast, where obviously cap rates have been, sub 5 in some circumstances, and they're chasing yield. I mean, do you guys think that in the event that California, has further restrictions, or Texas does, kind of like literally June 30th, here we are, they just went into another wave of restrictions. Do you guys anticipate that having any type of impact on the overall national platform with single tenant net lease assets, or no?
I mean, it certainly could. Like you said, I mean, a big portion of our buyers are coming out of those big markets. So it really just depends on, our business is heavy 1031 transactions. So it really just depends on those front end transactions taking place or not. If any new restrictions or laws that get put into place in California and New York start to slow down the transaction velocity, which obviously it has over the past few months, that's going to affect us, 3 to 6 months down the road when, we're looking for a pool of 1031 buyers. But yes, I mean, those markets are everything. I mean, for us, looking at the source of our buyers, the top 4 states make up 60% of our buyer pool.
Wow.
California. Great stat.
Yeah, California's 34%, New York 10%, and Florida and Texas are both 7%. So that's 58% of our buyers are coming out of those four states.
Huh.
Yeah.
Do you this is an interesting question, with the stock market performing the way that it is, do you guys see anybody pulling out of the stock market right now and transitioning into single tenant net lease assets, or is that still pretty quiet?
I mean, I would say that I continually hear investors say they hate the stock market. Now,
yeah.
Obviously they're talking to a real estate broker. Yeah, I hate it.
I do too.
Obviously they're talking to a real estate guy, a real estate broker. So there's a reason they're talking to me. But I might have mentioned this earlier, like we're starting to see a little bit of activity coming from those non-trade buyers that have just been sitting there. They're flush with cash, because let's face it, the economy, a lot of people are flush with cash still. I mean, the economy's been very good to everyone the last few years. And those guys that say they're in a non-1031 but they're interested in something. Yeah, I mean, they're in money markets. I don't really get it. We don't necessarily get into the details of what stocks they sold, but certainly that's what we're competing against.
Yeah, we agree, and I think it's safe to say Clayton and I are all in, right, on real estate, and not in the stock market. I mean, how can you trust an industry where there's high frequency trading and you're just consistently getting margins siphoned off the top? I mean, I don't understand it. Like Warren Buffett says, stick in the area you understand. So, can I ask you guys another quick question, just kind of changing the topic just a little bit? So as a developer, for example, or even from the investor side, when is the opportune time to buy an asset? So oftentimes as a developer, you're going through your entitlement process, you're getting everything teed up, and maybe you're in a position to pre-sell an asset, but you still have some exposure and some risk as you're getting up in until delivery date. You're turning the property over to the tenants. They eventually get to do their improvements, and then there's rent commencement, and then the clock is ticking and they're paying rent. So along that whole spectrum of time, is it fair to suppose that the best time to buy an investment or sell an investment is on the day that rent commences, or is there a different area or philosophy that you coach your clients on?
Yeah, everybody's different on this, and there's two schools of thought, and one is that you just wait until it's finished. You got a pretty finished product. Pictures look a little bit better than a construction project, but you really got to think about the timing and capitalizing on the market when it's there. So naturally, a lot of our business is pre-construction, and our rule of thumb is we try to be within a 4-month window from the estimated rent commencement date. Okay. So if your rent commencement is December 1st, we're going to say, all right, let's hit the ground running August 1st, but ideally no sooner than that. And the reason for that is, again, just the 1031 pool. If you go out any further than that, you're really going to lose that entire pool, because they're going to get nervous that you're not going to be able to hit the time frames. And as much as everybody likes to talk about closing pre-construction, we really don't see that. We see deals teed up all the time, but in terms of actually closing pre-construction, we typically don't see it. A lot of times it's everybody wants the cleanest stopple. They want to see them paying rent and open for business, and a lot of times they'll close that next day, basically.
Gotcha.
What I'm curious, and we'll work at wrapping this up. You guys have been gracious with your time, but going into the next few months, obviously there's a lot of deals that are transacting there right now, and there's a lot of developers navigating situations that haven't necessarily been traveled before. What would you guys counsel, a lot of developers that may be in the heat of a negotiation right now, and a tenant does hit them up on certain termination language? At what point, from a term standpoint, does an asset become not useless by any means, but significantly discounted? Because I can only predict, again, being on our side of the business, that there's going to be a lot of conversations regarding early terminations and kick-out clauses, which I know you guys deal with to a certain extent. What is the minimum amount of years? Obviously, having no termination is a preference, but if the tenant insists on it and insists on a kick-out clause, I mean, what is the minimum amount of years that a developer should really fight for in order to have that property trade out on the open market?
So, I mean, I'll use the Starbucks example. They traditionally, for a while, like on some of the, this is going back a while, some of their 10-year leases, they wanted a 5-year kick out, and that was devastating. And then they moved it to a 7-year kick out, and the properties were marketable under those circumstances, but you were still going to get a discount versus a 10-year lease. 10 years really is like the minimum threshold in the marketplace. We have investors say to us all the time, don't show me anything with less than 10 years left on the lease. Just don't show me anything like that. So really it's 10 years. I mean, when you're dealing with a tenant that only signs a 10-year lease, it's just very challenging. You don't have a lot to work with.
Well, and maybe that, again, that comes into a play where the underlying fundamentals of the real estate are all that more important.
Yeah. I mean, if it's obviously, if it's an A piece of property, you know, an investor is not going to get choked up on a 7-year termination right. Now, that said, if the rent, even if it's an A piece of property and the rent's, you know, $50 a foot when the market's 35, you know, that then becomes another challenge that you have to overcome.
Yeah. Well,
and on the last deal we did, you know, we had a tenant, national credit retailer, that wanted an opportunity to vacate, but there was a significant fee to do so. And if you just looked at it on a cash flow basis, it was essentially equivalent to a 9.5-year lease instead of a 10-year lease. So there was some type of discount there, but it was still stitched them in pretty significantly.
Right. So we had an example of that on a single tenant medical deal where I think there was a 7-year, maybe it was like a 6-year right to terminate, but when you added in the penalty plus like the unamortized portion of fees and TIs, it almost equated to a 9-year lease. So not as painful.
Right.
For sure. So to wrap it up, and again, thanks for being here, guys. Greatly appreciate it. You know, to close out, just give us, you know, a brief summary, but somewhat extensive to a certain extent, of where you guys kind of see the single tenant net lease market going in the next year to 2 years, and how are you counseling your clients that typically ask that question right now? What are you telling them?
Yeah, I'm curious to hear Mark's answer too, but I mean, I think it's probably going to be a little bit more of the same. I mean, I think we're going to continue to see the quality rise to the top, and people are going to pay a premium for that, in my opinion. I think for the right asset, we're probably not going to see a whole lot of shift. I think for those uses that have been struggling the most right now, maybe we start to see a shift, but at the same time, I could see, you know, 2-3 years from now, if things all go back to normal and there is a vaccine in place, you know, maybe we go back to the same sort of pricing scenarios that we did see on gyms and daycare facilities and all that, because at the end of the day, all of those concepts are also the ones that are Amazon proof, right? Mm-hmm. So you got two kind of different perspectives there. And I just don't see things changing that much personally.
Yeah. I mean, I tend to be, I'm always expecting the worst with most things, right? And I'm never really satisfied with just things, right? Like I call me negative on certain instances, but I actually feel like our product type is going to be just fine. I mean, and again, I preface this by saying, like, I am a sandbagger usually. Like, I just think though that we're going to be just fine. I mean, we're going to have some blips probably. I mean, third quarter will be weird. I mean, the election will dictate a lot. The vaccine will dictate a lot. I mean, there's going to be these things that happen, but I do think we'll continue to see velocity. I think we're going to continue to, and you know, you guys are on the development side, but I think there's going to be always going to be groups that want to do new deals. I mean, I remember back in, you know, I was doing the same thing back in 08, 09, 10, and there still was transactions to be had. I mean, yes, the pricing it plummeted, but there was still plenty of transactions that were to be had in our space. Now, the apartment guys in my office didn't make a check for like 18 months. I don't think that's going to be, I don't think it's near the dire circumstances we were in then. So we've got our head down. I mean, we're just going to continue to operate as we have. We're trying to be more informative with clients and trying to offer opinion if it's wanted. Not everyone has wild different opinions, but I think 2-3 years down the road here, we've got we've got some runway. It might be some turbulence for sure, but we're pretty optimistic.
Yeah, I mean, I think I see people chasing security even more. And again, out of all the different asset classes out there, the drive-through has prevailed through all of this. So to your point, you know, I see it looking pretty positive for the most part. So
yeah, and
because you're in such a, not to interrupt you, Mark, sorry, but you're in such a secure space. That's what you guys sell, is security a lot of the time. So
great point.
Yep.
Great point. Yeah, we're not selling 20% returns.
Yep.
That's a good point. Yeah.
Yeah. So, well,
and guys, we'll have it in the show notes. But for anyone who's listening and wants to jot it down real quick, what's the best way to reach out and get a hold of you guys, or get on your email list, or just stay in touch?
Sure. So if I'll just give everyone our website, and then they can find us on there. It's just netleaseadvisorygroup.com. And lease is no D. It's just netleaseadvisorygroup.com.
Perfect. Well, again, guys, thanks for being here. You're true pros, and obviously, you know, value your insight on everything that's going on. So knowledge is power, and, you know, obviously engaging with you guys and taking your temperature, no pun, is something that we definitely want to do and provide to our audience. So thanks for being here. And again, we'll put all your information in the show notes. So if anyone out there wants to get a hold of Zach or Mark, visit our website. So again, guys, thank you for being here.
Thanks for having us.
Thank you. Appreciate it.
Thank you, guys.
Thanks, guys.
Take care.